I have been a real estate broker since 1987. So I've been doing this for a while. And one of the interesting things about having done this as long as I have is there's certain things that have never changed. And one of them is the question of should someone rent a property or buy a property? I still get this question all the time. And there's lots of articles out there and books and computer programs and all that kind of stuff that's written. But what I've done is create a very simple one-page spreadsheet that shows you exactly what you need to plug in to make the decision based on the financial merits. Okay. Now there's other merits that are not financial that should be considered as well. But in Does It Pencil, we look at the numbers and we look at them the right way. So that's what this is about. So I presented this spreadsheet today to the group and explained to them how it works. So this is a very important webinar if you ever are confronted with this or you're just curious about it. And what's important about this webinar is that I go through each one of the steps that someone needs to consider when they're making the decision to rent or buy, or if someone is assisting someone to make that decision. So I hope you enjoy this. You can watch it. You can listen to the podcast. It's all available at the website, doesitpencil.com. Doc, how's it going?
It's going well. Looking forward to the day. Missed not meeting last week, and I find this topic for the day very personal because I'm at that point where I have to start talking about this.
Yeah, I think it's a good topic. That's why I picked it. Jen, how are you? Haven't seen you for a while. What's going on in the great state of Mukilteo or Everett or wherever you are up north, Bo?
Also known as Camino Island. Yes.
Mano.
Doing great up here. So
Guys having a good summer?
the summer has been spectacular. Gotta say, we've had a lot of friends and family, and it's been beautiful weather. So
Nice. Is it raining up there today? Or kind of,
not yet.
yeah. But very wet roads in Gig Harbor this morning. Simon Bradbury from the great state of Reno. My brother from the UK. How are you, man?
Very good, Joe. Good to see you.
Good to
be
see
back.
you. How you been?
Yeah, very well. Thank you, Joe. Yeah, very well.
That is outstanding. All right. Okay, Mr. Coe, are you happy today or as happy as you can be?
I am jam-packed busy, so I guess that's good.
Yeah, well, it can be. You look good.
A couple new listings, that kind of stuff. So hopefully they sell and life will keep on going good.
That is the purpose. Okay. Well, I've been thinking about something. Shocker, I know. And what I've been thinking about is the housing market and just all the noise out there and what should people do? You know, I mean, really, since COVID, it's been a lot different, as everybody knows. So what I did yesterday was I did what I always do. I'm trying to solve math problems is I built a spreadsheet. And you're going to get a copy of it. And I'm obviously going to show it to you. But what I want to do first is just kind of do the 50,000 foot view thing and kind of explain to you why I did this, how I approach it, limitations, and that kind of thing. All right. So if you want to make some notes, like I always say, pen and paper for this thing. I think the first thing that we as brokers, advisors, investors, whatever, are trying to do is really one thing. I know it sounds simple, but it's also pretty damn difficult for a lot of people. And that is make a decision. Okay. That's what we're trying to do here. We're trying to make a decision. And I think it's important to start with that because it's real easy to get in the weeds on all this kind of stuff, especially with spreadsheets and numbers, all that kind of thing, which we will get to. But I think that's where we start is we're trying to make a decision and we have two choices in the context we're talking about. And the choices are very simple. Should you buy or should you rent? Okay. And that's it. After those two boxes are checked, the whole thing starts getting a lot more complicated. Okay. So The way that I like to explain these kinds of things is to give you just sort of the verbal part of it first, and then I'll do the visual part. Okay. So the way that I'm going to approach this decision financially is using internal rate of return analysis. Okay. Now in Does It Pencil speak, heard me say this before, IRR is probably my favorite tool. And it's my favorite tool for a whole bunch of reasons. But the simplest reason, the most important reason that I like using IRR for these kinds of decisions is that it takes into account a holding time frame. Okay. It takes a look at the cash flows in and out, and it takes a look at the appreciation. Okay. It's the only tool that I've ever found that checks all three of those boxes. And again, going back to the first thing, what are we trying to do? Trying to make decisions. And that decision touches all three of those things. Okay. What's your time horizon? What's your cash flow situation? And what kind of appreciation do you have? That's why I chose internal rate of return. Okay. So that's the first thing. When I show you this template that I built, what I chose was a 5-year holding time horizon. Okay. Now you can go in, it's in Excel and it is locked, but I'll show you how to unlock it. And you can change your time parameters to whatever you want. Okay. It's not that difficult. I'm not going to do a big tutorial on Excel today. All that stuff's readily available on YouTube. But I'm going to use a 5-year time horizon because it's simple. People understand it. And it's just kind of the sweet spot of these kinds of deals. The third thing that you're going to see in this analysis is you're going to see the idea of an alternate investment. Okay. And the fulcrum on which that's going to swing is the down payment. Okay. So if you think about it, if you've got these two choices, if you're going to get into the house, you need a down payment. And in our first example, I'll just use 20% down. So the comparison with the T accounts for internal rate of return is going to be taking that down payment money and putting it into the house and having the house go along and do its cash flow and appreciation thing, or taking that same money, putting it into a different investment, assuming a rate of appreciation, and then paying the rent. So that's as apples and apples as I can make this thing and still keep it fairly simple. Okay. The next thing to contemplate, if you're going to do this and you want to be honest about it, is the tax implications. Okay. So I'm going to give you a couple of tax things that are pertinent to this spreadsheet and pertinent to the world and hopefully pertinent to your life that you should know for sure. Okay. So first of all, and you probably heard this before, in the primary residence on the capital gain, it is excluded $250,000 per person, $500,000 married filing jointly, if you own the asset for 2 of the last 5 years. Okay, most people have heard about that. It's been around for a while. Alternately, so what you're going to see in the house thing is when you go to sell it, there's no tax. I just omitted that line. I just assumed that it would be a tax-free sale. Now, if they make more than 500,000, or if they don't live in their 205, and there's other mitigating circumstances like job moving, medical, that you can read the tax code if you're interested in that. I'm just omitting the tax for this simple analysis on the sale of the home. We'll just say it's stocks. The other investment, the alternate, we are going to recognize a long-term capital gains tax of 15%. So in investments, there's 2 kinds of capital gains. There's a long-term and a short-term. The long-term capital gains tax, which is beneficial to the investor, kicks in if you hold the asset for at least 1 year and 1 day. If you hold the asset for that long, then the most you will ever be taxed on the gain is going to be 20%. Now I use 15 because it actually goes from 0 to 20. So if you make no income in a year of the sale of an asset, you could pay no capital gains tax. It triggers based on your taxable income that year that you sell the asset. If you make over, then like it goes up every year, but it's like 480,000 if you're married filing jointly, then your tax is 20%. But most people fall into that 15% maximum long-term capital gains bracket. So I just use that for estimating the capital gains tax due on the investment. Okay, now again, I'm just telling you the stuff verbally. You'll see it visually on the spreadsheet just a minute here. Okay. Once you have all that information, then you just run IRR. Okay. So let me summarize this IRR thing one more time. And I've said this 10 million times in classes and at least 1 million times to you guys. The way to think about an investment is like 3 legs of a stool, or really the 3 elements of a story, which are beginning, middle, end. So in the beginning, when you buy the house, you put up the down payment or you invest the money. That's the beginning. We refer to that, it doesn't pencil speak, in the T account and with IRR as time period 0. That's when I make my initial investment. The middle is the ownership part. And that's going to be the 5 years in our example. 5 years of making mortgage payments, 5 years of paying rent. Okay, now I didn't mention this yet. On the ownership, where you're paying a mortgage with interest, I am assuming no tax deductibility because I am assuming, based on the recently passed big, beautiful, bold, bitchin' act, whatever you want to call it, the standard deduction for married filing jointly is $30,000. So the government's giving you a $30,000 credit anyway. If you pay less mortgage interest than $30,000, you're better off just taking the standard deduction. Okay. If you pay more than that, then you would itemize, and then you would have to extrapolate your interest, and that becomes your deduction. I am assuming, for simplicity purposes, that you're just taking the standard deduction. Okay. And the example I'm going to show you is a mortgage of like 400,000 at 6.5%, which gives you like 25,000 a year in year 1 in interest. So it's still under the 30,000 threshold. But I just need to point that out. If you're doing this for someone and they have more than $30,000 in interest, that's a different calculation based on their tax bracket as far as deductibility. But again, we just assume it's a push because it's going to be under the standard deduction. Okay, so the middle, again, is making the mortgage payment and rent payment. And then the end is where you recognize the appreciation. So what you'll see when I measure the appreciation in the sale of the home is the future price based on an assumed rate of appreciation minus the payoff of the note at the end of the 5th year minus closing costs, which I think I assume at like 10%. That will give you what I call, in Does It Pencil, your pre-tax sales proceeds. That's the net amount you walk out of escrow with and you've paid your tax. Okay, if any. Well, there's no tax on the home. On the alternate investment, which I'll just call the stocks, you'll have the rate of appreciation, but we will apply a 15% long-term capital gains tax rate. And then we'll take that and put it in the T account and run the 2 IRRs. Okay, so Tian, I have a question for you. Can you, just for everybody's benefit, repeat back everything I just said word for word in the last 5 minutes? Can you help us out with that, friend? Yeah, I know.
I don't think I can. I was waiting for the demo.
Yeah, that's why we're really glad all this is recorded. That's why we're glad about that. Okay. Here is thy spreadsheet. And I'm going to wait until the end to give this to you because if I give it to you now, you're not going to listen to me. And you need to listen to me, at least for now. Okay, so this is a one pager. Pretty simple stuff. Fill in the cells that are in red. The cells that are in black automatically calculate themselves. Let's shrink this a little bit so you can see. So it all fits on one page. Okay. It is locked so that you cannot go in and corrupt cells. So if I try to change that, that's going to come up. So all the black cells are locked. All the red cells are unlocked. So the red ones are the ones that you fill in. And if you see the little red triangle, there's a little notes that I put in there just to remind you of certain things you need to be reminded of. When it's all done, it will populate these 2 T accounts and solve for the IRR. It's really cool the way it works, actually. And then at the bottom here, I just put a few friendly reminder notes. Okay, so number 1, it's a 5-year analysis, fill in the black, or fill in the red. Black takes care of itself. Primary residence, 2 5 years. Is that blocked there? I don't know what it's doing. Oh, there we go. Capital gains on the lease is 15%, no tax deductibility for the mortgage. So all stuff I just explained. All right. Okay. So let's go through a simple makeup example. Let's say that I'm going to buy a house for $500,000. Okay. This is the house thing. This is the purchase scenario. And I'm going to assume, and I'm just going to use the number that you guys have given me, that the rate of appreciation is 3%. Now, any of these red cells, you can go in and change at any time, and I'll show you that. And we'll assume sales costs of 10%. Okay, now before I go forward, here's a really important point I need to make. The IRR model assumes a beginning, a middle, and an end. So what that means is you're making an assumption that you're going to sell the property at the end of the 5th year. You don't have to sell it, but you do have to make an estimation of the future value. Okay. I'm just using a 3% rate of appreciation because most of you guys have told me in the last few months, that's what you would use. That's why I used it. And I want to be just like you. Okay. Let's say that this buyer can get an 80% loan to value. So the black cells auto calculate. That's a $400,000 loan with a $100,000 down payment. You get a 6.5% interest loan over 30 years at 12 payments per year. Okay, so you'll notice here, your monthly payment is auto-calculated, your number of payments, and the sum of total payments is calculated. Anything that is black, you do not touch, it does itself. Similarly, right here, we've just figured out what your net sales proceeds are at the end of the 5th year, based on a 3% rate of appreciation and paying off the balance of a $400,000 note. All done right there. Okay, pretty slick. This,
Hey, Joe,
yeah,
can I interrupt for a sec? Does that monthly payment include taxes and insurance, or is that just principal and interest?
that's P&I only.
Got it. Thank you.
Yeah, that's a good point. And maybe I probably should go back and modify that. You're right about that. But no, it does not. Okay, so let's go over to the lease scenario. So here, the initial investment is $100,000. So the way this works is it copies the value in this cell and automatically puts it here. So it calculates your down payment here and just throws it here. Same thing here. This 5 years is pulled from this one. So let's assume that you can earn a rate of appreciation on investment of 10%, just to keep it simple, okay? So when I release that, here's your future value of your investment. Here's your gain. This section calculates the tax on the gain. Okay, so here's your tax paid, a 15% default rate, and here's your net after. Okay, so for a house that's $500,000, I'm going to assume I'm going to pay $2,400 a month in rent, and we'll come back to that. Your mileage may vary.
I feel like I'm lost. The lease is just rent, right?
Correct.
So why is there a gain?
Because you took the $100,000 you would have invested in the down payment and invested into something else that paid you 10%,
Oh, okay.
like stocks or bonds or whatever.
Okay, gotcha.
Okay. So one thing I didn't do, it's important you got to do, you got to enter the monthly rent as a negative. And I put a little note here. Okay. So here's the rate of return on these two choices. Isn't this interesting? So owning the house, you're losing 17%. Owning the stocks, you're losing 14%. Okay, now here's another note you can make. If your internal rate of return is negative, it means you had no return of investment. So in other words, you paid out more than you got back in, either in the interim middle period in cash flows or in appreciation at the end. Okay, that's why both of these are negative. Okay, so let's just stop there for a second. Okay, Jen, did that all make some sense to you?
One of the questions that I did had, and I didn't stare at the sheet long enough. When you're looking at the end, I love beginning, middle, end. First of all, thank you. That has just been like a saving grace over the years. But on the end component for both the, I don't know, own or rent, I just didn't see. I'm assuming if I put $100,000 into stocks, yes, I'm getting my return annually, but then do I get my money back when I sell that whole lump? And then I'm also going back to, is there like a whole cost of sale to recapture on the ownership side? I didn't stare at the sheet.
Sure. Yeah, no, let me cover both those well put questions. Okay, so first of all, on the sale, I put a costs in here of 10%.
Okay.
Okay, I did not put a cost in on the stocks. I mean, if you're going to be like in an ETF, an exchange traded fund, you're going to pay like 0.03. It's really next to nothing.
Right.
The other thing I did not explain, well, at all, not just inadequately, was the 5th year. Okay, so let me explain this. When you do IRR and when you do a T account, in the last period of ownership, whatever it is, in our example, this is a 5-year, whatever your last time period is, you add the cash flows to the sales proceeds in the final year. Okay, so if I go back here and I look at the one for the stocks right here, you can see, actually it's this one right here, this 123,093. So this is F22 times 12, which is your monthly payment, plus F19, which is this one right here, the 151. So effectively it's 151,000 minus 2,400 times 12, and that's what goes in this last year. Because you paid all the rent, we assume 12 months worth, and you received positive this net gain. For this one, for the ownership, you paid the whole mortgage for the year, which is 2528 times 12, negative, plus you received in this 147,229. That's what gives you this number here. So yes, you are recognizing both at the end, and no, I did not put in a cost of sale on the investment because it would just be so negligible. But I got to tell you, having just sold a couple pieces of property, at least in Washington State, my God, the closing costs have gone up. The taxes, mostly.
Can we go back? I have one question, Joe.
Yeah.
The ownership on the sale portion of it,
Yeah.
when we're looking at, yes, there's the 3%, oh, there we go, 3% rate of appreciation. Is that appreciation on your whole purchase price, or is that only factoring in the down payment leveraged? Like how?
You are
Realize-
just winning Jeopardy today, Jen Hudson. That's the next thing I was going to bring up.
Sorry, I'll just stay quiet. Okay.
No, you're good. You're good. Okay. So this actually is one of the key features of this, and I was going to bring it up, but you are the great Kreskin, so you think ahead of me. Let's talk about leverage for a minute, okay? Because this is one of the reasons that the real estate ends up being a better investment. It's actually the reason mathematically it becomes a better investment, and it's very simple. When you buy the house, you are leveraging. You are taking your $100,000 and you are buying an asset worth $500,000, right? So you control 500,000 with 100,000. That's leverage. It's not the 100,000 that appreciates, it's the 500,000 that appreciates. So you get far, far, far more appreciation on the home than you do on the other investment, because the other investment, all it's appreciating is your down payment, your 100,000. Okay. Hope that was helpful. Hopefully I explained it in a way that was understandable. If you're new to this kind of stuff, to the processes and the jargon, all that kind of thing, you might want to watch or listen to this a couple of times, okay? With practice comes mastery. But this is the kind of thing that we go through in Does It Pencil training. So if you're interested in this template, there's going to be a short course coming that will include the template and offer more in-depth detail and explanation so you really understand how to use it. And so this is going to be available with all their webinars and the other courses and tools and articles and everything else that we publish at the website, doesitpencil.com. Thanks.